All right, if you're a founder, let's talk funding. You already know about the usual suspects, right? But what if you could find a partner who brings way more than just cash to the table? Today, we're diving into the world of corporate venture capital, or CVC. The big question is, could this be your next and maybe even your best strategic partner? Let's figure it out. So let's just kick things off with a number you absolutely cannot ignore: 2 times. According to the data, startups that are backed by a corporate venture capital firm are twice as likely to succeed. In fact, if you flip that around, companies without CVC funding are more than twice as likely to go bankrupt. That is a huge, powerful statistic, and honestly, we're just getting started. And don't for a second think this is some tiny, niche corner of the funding world. In 2024, CVCs were involved in 28% of all global venture deals. That is nearly a third of the entire pie. We are talking about a massive, influential force that is actively changing the game for startups everywhere. So what is going on here? What's driving this huge trend? Well, we're calling it the CVC revolution, and it really is a fundamental shift in how big companies think and act. A full 40% of major corporations now have their own venture units, and they're not just looking for a quick payday. They are on the hunt for innovation, for a strategic edge to stay ahead. Okay, so let's make sure we're all on the same page. What exactly is corporate venture capital? Well, simply put, it's when a large company takes an equity stake in a small, innovative startup. But, and this is the most important part, they have dual goals. Yes, of course, they want a financial return, but they also have a strategic goal that has to align with their main business. And that dual motive, it changes absolutely everything. So, if you do partner up with a CVC, what's really in it for you? This brings us to the good stuff, the incredible upside. Because a real CVC partnership offers so much more than just a check in the mail. It's way more than just money in the bank. We're talking about the CVC advantage. I mean, just imagine for a second. You get instant access to deep industry expertise. You can tap into massive corporate networks and established distribution channels. They can even provide you with key technical resources. And they often offer what's called patient capital, which means they have longer timelines, giving you more room to breathe and grow sustainably. It's a whole package that gives you instant market validation and credibility. Let me give you a real-world example of this network power in action. When Amazon invested $700 million in the electric truck startup Rivian, they didn't just hand over a check. Nope. They also placed a massive order for 100,000 electric delivery vehicles. You see, that wasn't just funding. It was a company-making contract that basically secured Rivian's entire future. Or how about this one? When Salesforce Ventures decided to back the data warehousing company Snowflake, it acted like this huge stamp of approval for the entire enterprise world. All of a sudden, other big corporate customers who were maybe on the fence felt way more confident signing on with them. That is the kind of validation that money just can't buy. And think about the distribution advantage. When Walmart invested in the vertical farming startup Plenty, it didn't just bring capital. It brought its stores, literally thousands of them. Plenty's produce was suddenly set up for nationwide distribution. I mean, can you imagine trying to build that kind of network from scratch? A CVC partnership can unlock it almost overnight. Scott Lennett from Surrey Partners just sums it up perfectly right here. It's all about building real, tangible value that goes way beyond that first funding round. The right CVC can be the catalyst that turns a promising startup into a true industry leader. Okay, so far this all sounds almost too good to be true, right? Well, every great journey has its trials, so let's talk about the other side of the coin. We have to discuss the risks and the challenges you need to navigate really carefully if you go down this path. Which, of course, leads us to the one question that's probably on your mind right now. So, what's the catch? Well, there are definitely a few hurdles. Working with a giant corporation often means slower, more complex decision-making, which can be incredibly frustrating when you're a startup trying to move fast. Your strategic goals can get misaligned, pulling your company in a direction you never wanted. Your intellectual property, your secret sauce, could be at risk. And, the CVC world itself can be volatile. Get this, a third of CVC programs were shut down or paused in just the last 3 years. That could leave you totally stranded. Let's really zero in on that IP risk because it is so significant that it actually has a name, the shark's dilemma. Think about it. It's this intense pressure a startup feels. On one hand, you've got these incredibly attractive resources, the distribution, the expertise, the validation. But on the other hand, there's this very real risk that this huge corporation could see exactly how you do what you do and then decide to just build it themselves, becoming your biggest competitor. And listen, this isn't just some paranoid fantasy founders have. It's a recognized phenomenon that's been studied by researchers. This quote here really underscores that core tension. The shark's dilemma is a fundamental challenge that you absolutely have to address head-on in any CVC partnership. So, knowing all the risks, how do you actually navigate this successfully? How do you get the good stuff without getting bitten? Well, that brings us to the guidebook. Let's lay out a clear map for how to win over your CVC partner and protect yourself at the same time. Success here really boils down to strategic alignment, and you can think of it as a four-step process. First, you have to do your homework and deeply research the corporation's priorities. Then, step 2 is to propose a really clear plan for how your solution integrates with their business. From there, you proactively define governance roles so everyone knows who does what. But really, all of this is built on the final and most crucial step, building trust through radical transparency. And this quote from founder Aaron Silvers just absolutely nails it. Investors don't just invest in ideas, they invest in trust. This is especially true for CVCs. Being upfront about your challenges, sharing your wins and your losses, that shows resilience, and it builds the kind of credibility you need to forge a true long-term partnership. All right, we've covered the good, the bad, and the how-to. And all of this brings every founder to a crossroads. It's time to make a choice. It's time to choose your path. Corporate venture capital or traditional venture capital. This table really lays out the core differences pretty clearly. A CVC's primary goal is both strategic and financial. A traditional VC, they're focused purely on the financial return. CVCs often bring that patient, long-term capital, while VCs are typically looking for an exit in 5 to 10 years. And the value they add is different too. The takeaway here is pretty simple. These are fundamentally different kinds of partners, and you need to pick the one that actually fits your vision. At the end of the day, there is no single right answer here. The perfect partner for you depends entirely on your startup's specific needs, your industry, and your long-term vision. Do you need a strategic ally who can also become your biggest customer? Or do you just need pure capital and expertise in scaling fast? And that's really the question I want to leave you with. After weighing the massive potential upside and the very significant risks, take a hard look at your company and your goals. Is your perfect partner a traditional VC, or could it be a CVC?